Hello traders, this is Chris Buss with Traders Profit Compass with a Weekend Profit Navigator for Sunday, April 24th. It's 1:17 in the afternoon on Sunday as I start the video. What I want to do today is do a quick macro review of where we're at, go over the market internals, go over the indexes, and then take a look at the individual SPDR sectors. We've got a huge week of earnings coming up. We've got quite a number of the mega cap tech names. I think Alphabet, Microsoft, Facebook. I don't have the list memorized. The calendar is on the blog site, so you can go there and get the big names and the actual dates that they report there. So let's just do a quick macro review. And we've basically got three themes that we've been holding as our framework heading into the summer. Number one is shrinking liquidity. We've got an FOMC that is raising rates and at the same time about to initiate a transition from quantitative easing to quantitative tightening, and that is going to suck liquidity out of the system, making it more difficult for financial assets to increase in price. I have a link on the blog site to a very good video on the linkages between liquidity and financial assets. It's about an hour long. I highly recommend watching that video if there's any doubt in your mind, or if you just want to have a nice review of how liquidity affects financial assets. I highly recommend that video. The second theme is persistent inflation, and that's really what is driving the actions by the Fed. They have a mandate to tackle inflation, to get it down as it's running, 7, 8, 9, 10%, depending on what you want to look at. And the third theme is commodity supercycle, that we have just come out of a 10-year bear market in most commodities, including the grains, copper, iron ore, almost any commodity you can imagine is coming out of a 10-year bear market where there was a severe cutback on CapEx expense. Therefore, there was no investment in these sectors for, the better part of 10 years, spanning from the oil industry to all the mining. And then we've also got a demand increase in a lot of these commodities based on a push to convert from internal combustion engines to EVs, as there is a global push to reduce carbon emissions. So, and that poses a big problem to the Fed, because if you think about it, raising interest rates doesn't really have a whole lot to do with copper prices. It doesn't have a whole lot to do with corn prices and wheat prices and oil prices. So all the things that drive inflation are not controlled by the Fed. The only thing the Fed can do is slam demand by creating a reverse wealth effect. What is that? Well, just like they blew the bubble up after the great financial crisis 12, 15 years ago, by QE and taking interest rates to zero, that created a wealth effect that, your home price went up, 15, 20% every year. and the stock market went up every year, the ultimate buy the dip environment, whenever there was a pullback, you could buy the dip and the Fed would be there and make sure that those asset prices went up. That's gone now. So now we've got an initiation by the Fed to create the reverse wealth effect. Make sure asset prices go down. And the way we summarize that in our morning videos over the last month is the FOMC has the high ground. Think of the military analogy. You always want to have the high ground when you're defending a position. You don't want to be going up the hill. You want to be looking down on your enemy. And so if the enemy is a rising asset environment, the FOMC now has the high ground, and they've got the bazookas to make sure that if asset prices, pop their head up, that they get slammed with the bazooka. And, in actuality, all this has been chatter because they haven't raised rates yet, right? We got this little 25 basis point thing a couple weeks ago, but, that's not going to stop inflation. That's not going to knock asset prices down. So they've been jawboning it down, and the market has been increasing rates at a rapid clip, and now that's starting to have an effect on the asset prices. So let's get into the charts and the internals and kind of see where we're at on prices. What I've got here is a 40-year chart on 10-year bond yields going back to 1981. If you go back to the peak, I think it actually peaked over 20%. And you can see that for 40 years, we've been in a bull market for bonds. Yields coming down, bond prices going up. That's why a lot of people call it, the biggest bubble ever. And if you go out into the financial resources and find yourself a 100-year chart of bond yields, you will see that there was a 40-year bull market in rates from 1940, start of World War II, to 1980, where interest rates peaked or bond prices bottomed. That was, right back here. And now we've been on the other side of a 40-year mountain in rates, and we've been rolling down the other side. So 40 years from 1940 to 1980, yields were rising, and for the last 40, they've been falling. But look what's happened just in the last year and a half. Here's your COVID low at 50 basis points. We rocketed out of the COVID crisis. As things opened up, we had a slight pullback, but for the last 6 months, it's been a quick moonshot up to basically the 3% level, right where we were at the lows. Remember the Q4 2018 rug pull where the market went down 20% in 3 months, and then you had the Powell pivot January 2019, and then that was taking things back to zero on the Fed fund rate. So now we're back here at 3%, threatening a breakout with them talking 50 basis points in a couple weeks at the May meeting, and even throwing out there 75 basis points on rates. So a breakout above 3% could start a fast move. And, we're going to have to wait and see, is this the start of something structural where if you look at commodity cycles, they usually go in 10 to 15 year cycles. There was a big commodity boom in the 70s. at least 10 years that fueled a lot of inflation. There was a commodity boom that lasted 10 years from 2000 to 2008 when China got put into the WTO. There was a boom there. That's when oil hit 150. And now we may be at the start of another 10-year bull market in commodities where these rates will drive higher. One thing I forgot to mention, please run your video player at 1.5x. I think you'll enjoy that speed a lot better than normal. So run it a little bit faster. So here we are. I think equity prices are reacting to the speed of this bond move, and I would have your eyes peeled on bond yields going forward, and 3% is a good toggle point. For those not familiar with my work, if you're new here, first of all, welcome. I put a lot of faith in these McClellan oscillators at the extremes. We came out of a extreme overbought. Now we're on the way down, and we're down here at minus 46 with 2 hard days of selling. I think we got more to go to the downside. Start raising your caution level if you're short as NIMO moves below minus 60. You can see that in the most recent history there have been a lot of reversals along the line of 60, but also minus 90 has been a great spot to, that's where the rubber band really, unless you get a COVID low or a 2018 absolute collapse, hard to go below minus 90. So I would definitely start transitioning your mentality from being short at minus 60 is definitely going from green to yellow and proceeding down to minus 90 is, get out of your shorts and expect a bounce. Here we see the same thing on the NASDAQ, minus 41. I think if we get a sizable sell event tomorrow coming out of Friday selling, I think we're going to be pushing down into this minus 60, minus 90 area. Another cautionary note on positioning is my extremometer, which is basically looking at the put-call ratio, and I've got 2 levels of places to watch. Above the red line marks extreme call buying. Below the green line denotes extreme put buying. And you can see that back here in COVID, we had a massive cluster of put buying. But along the way, you can see when we get down below the green line, usually places where we get bounces. You can see them here. The metric is a lot better at predicting or timing bounces than it is tops. You can see a lot of excessive call buying, up here, and those didn't result in any tops. So this is more of a bottom picking type scenario. So we've had 2 big days of selling. We know that sentiment is pretty bearish out there. Up until now, that hasn't resulted in a lot of people piling into puts until Thursday and Friday. So this is another cautionary indicator saying that, when everybody piles into puts is when you and I should be thinking about covering. So keep that in mind. I'm going to run through a series of charts here that kind of shows you where we're at in the different segments of the market. Here we are on mid caps, diving towards oversold, getting really close. Here's the NDX. We're already down in the oversold area where there's a low risk reward for continuing to stay short. Let's see. Here's small caps, still relatively high on the scale. I think we got more to go to the downside there. And SPX diving down towards the 25% level with room to move lower. Now just remember that these are bands. They are not like absolutes. So what they're saying now is probably more room to the downside. We've got cautionary levels of being oversold. And just remember, things don't go down forever. The rubber band extends, it gets overextended. People get panicky and then they cover, and then that's when you get that snapback. So have that in your mind this week as we open, tonight on futures and then tomorrow, of the positioning of those types of things. Now, I haven't spent a lot of time on this particular metric, but now I think it's going to be somewhat important to think about going forward into the early part of the week. On the top, we've got the S&P 500. On the bottom, we've got 3-month volatility versus 1-month volatility. And then on the lower panel, we've got 1-month volatility versus 9-day volatility. And what happens is when you get a volatility term inversion denoted by this lower band in each of the panels where those volatility measures invert, those are often really good places to look for a snapback. And I've got, places here where both of the measures either got really close or inverted. And you can see that when you get that move, it's often a very good place to look for a bounce. Our last event was back here in the February-March timeframe. We had that initial move where we actually got a term inversion on that February low right here. That resulted in a kickback. We came down again. Again, we had a term inversion on both panels. We got a big rally, and now these volatilities are nosediving lower, meaning we're getting closer to a volatility term inversion where I would again be looking for a bounce. The nice thing about these measures is you can get them in real time. So during the day, if we start getting some selling, you can recreate this chart and look in real time. I have not found a good real-time measure for the oscillators, NIMO and NAMO. Those are primarily end-of-day measures. So, you're sitting there, you're getting, a lot of selling. You don't kind of really know where you're at till after the bell, and then you might be saying, oh, man, I should have covered, and then it's too late. So I've got a scenario here. I don't need to read it to you. You can read it yourself. But we talked about on Friday those Wall Street axioms coming out of a bad day of selling on Thursday. We said, watch out for a bad day of selling on Friday. Why? Because you're heading into a weekend, after a bad day of selling. And we got follow-up selling on Friday with a terrible close. I mean, we closed right on the lows, and then you got that Wall Street axiom of bad selling never ends on a Friday, and then the follow-up of turnaround Tuesday. So here is a scenario where we get a lot of selling tomorrow with the potential for a panic flush where we breach the March lows, and then there's a big flush, and then that will set up for oversold conditions across the board. All of your oscillators will be well below 60. All of your, those different metrics that I just showed you on the different segments of the market, small cap, mid cap, large cap, and NDX will be oversold. And you'll also have volatility term inversions here tomorrow afternoon if there's a big move down. So what I will be doing and looking to do is waiting to see if we do in fact get that, capitulation type move, and then be looking to cover any shorts into Tuesday and either, go out on a limb and get a few longs or just go to cash. That's kind of going to be a game time decision. I can't tell you exactly what I would do, but I would certainly not be adding to shorts tomorrow unless you're intraday and you kind of know what you're doing. If you're swing trading, I would not be adding to shorts tomorrow because you're basically shorting into the hole when the move is, I think, almost over, at least near term. And what I wanted to show you here is it's really hard for SPY to go down more than 4% in a day. So, we could come down here, 2.5% like we did on Friday. 2.7%. Come down here and have that, those prior lows hold. Or if we break it, that's when you get that flush move and, potentially come down like 4% type of a move. So I think this is something I'm going to be watching really, really closely on tomorrow to see if there's that type of move. If there isn't a lot of selling tomorrow, I think I'm just going to stay short. I don't think this is going to be a place tomorrow to look for some kind of a big bounce. Let's get into the price charts. Here I've got the SPY weekly. We had the highs. We came down to the February and March lows. We got a kickback rally, and now we've rolled over. We've been following the 40-week moving average. That's analogous to the 200-day on the daily chart. Notice that we've dropped below our highest volume price level on the chart here with this big level here. Now we're below the 40-week. So now at a bare minimum, we come down here and test these February lows, and I've got the Fibonacci retracement levels here in black off of the COVID lows, and that shows us that even a nominal 38% pullback brings us back into the 380 area. And, as far as retracements go, 38% is nothing. You wouldn't even say, if we went down to 38% and started heading higher, you'd conclude you're still in the uptrend, So you can look at it from that perspective. And we always trade level to level, so there's no need to, speculate about doomsday of down here at a 50% or 618 retracement level until we get here. So just go level to level. But I think if we break the February, March lows, then you've got to be open to a move down into 380. That doesn't necessarily mean it's going to happen at, in a straight line, but that would be my target. And notice the void on the charts where there's not much technical support in that below 410. Here we are on the daily chart. Big bearish engulfing candle, follow-up selling on Friday. We're down right on this uptrend line. I think tomorrow we break, and we had already on the weekly chart showed these February lows down here at 410. And so tomorrow, if we break that, really if we open lower than we did at the Friday close, then I think you're going to see some follow-up selling tomorrow. Moving on to the NASDAQ, where we've talked about in earlier episodes that your NASDAQ stocks are going to be much more sensitive to the rate increases than the SPY. Well, for one thing, your SPY has a lot of defensive sectors in it, utilities, REITs, healthcare, staples. Those are defensive sectors. So very oftentimes, when tech is falling apart, your utilities and that kind of stuff will be rising or not going down as badly. So when you move over to the NASDAQ, you don't have any protection from that. And we've seen this past week names like Facebook, Netflix, Google get destroyed. So even they're finding the generals now, and that's not even talking about ARK and the bubble names and the Ponzi names and the outright frauds that have come out of the woodwork the last 5 years and have benefited from all that free money. Now, with rising rates, to a large extent, those lower quality names have been exposed. So here we are. We're already closing on a 38% pullback in the NASDAQ. So now all eyes on the prior lows. And what I want to point out here is on the weekly chart. Well, first of all, bearish regime on the RSI, bearish regime on momentum, and a big gap in the charts, or I should say void, not a gap, a void in technical support, that if we lose 310, I think we come down to 280, 285 rather quickly. And remember, we've always got that, or we have shown in previous episodes, that classic first leg down, A, kickback rally, B, C move. And if you just, I haven't got it here, but even if you just eyeball it, this distance here, from this distance here, puts you down in that 380 area on an A, B, C down move. And then that would align with your 50% retracement. And then you've got a large volume over price bar here that if it wanted to go further, you've got nice alignment between the 618 and technical support down in the 260 area. But like I say, that's a long ways from here, and we don't need to really, concern ourselves with a doomsday scenario until the evidence starts to present itself that that's where price is going. So here's a price action from Thursday and Friday. We have said that the NASDAQ was in a much poorer technical posture than SPY. Why? Because on the SPY chart, if you look at a relative place on the chart, this was the 200 on the SPY chart. We can go back to look at that right here. Here was the 200, and on Friday, the 200 let go. On Qs, 200 is way up here, and we've got a full bearish stack on the EMAs. What is that? 200 on top, followed by the 50, followed by the 20, followed by the 8, and price below everything. That is a full bearish look, no question about it, no equivocation. It's bearish. And so now, while the SPY has quite a good ways to go to get to those February, March lows, on the Qs, we're there right now, just really looking for, not many points at all. We're sitting here at 325, and so we were down almost 9 points. If we were to go down 9 points tomorrow, we would be below this support zone here, and then that would open up a bigger move towards a level down here at 309, and then you've got this gap that remains open between 298 and 305. So tomorrow I would be watching this little support zone between 322 and 318, and if we get below this 318, that would be where I would anticipate some type of a panic move. Once everybody recognizes and the algos recognize that we've lost those prior lows. Remember, whenever you lose a level from above, that's bearish. Bring in a lot of selling, and then that's when you get that, massive type move where we could come down and even touch this 309 or this 305 and then set up for a big oversold bounce into Tuesday if that scenario plays out. IWM, we've said this has been bearish the whole way. It really hasn't broken down to a massive extent, but this has been below the 40-week for really all of 2022, and so we had a year-long consolidation between 210 and 230. We had the bull trap breakout. Whenever you have a bull trap or a false breakout and then have price return to the range, we've seen that quite a bit lately, then your target becomes the bottom of the box. We found that. We had a breakdown from that 210 area, measured move. What was the width of the prior range? $20. What was the technical target for the next move? If this range was 20 wide, your target's 20 wide. We got that, 210 down to 190, and we've spent all of this year consolidating between 210 and 190 with just a ton of chop. But now we are testing the bottom of that range. And so if we get a break there, that's going to bring in a lot more selling. And if you get a break of this $20 range, where is the next range? And so your technical target would be another $20 lower. So we could be looking for a number down at 170, and the thing about it here is that there's nothing there at 170. So if we were to break down, I would look for a move down to 165. Why? You've got a massive void in the chart where I don't think there would be anybody home, and you've got a massive ledge of technical support back here at 165, which also aligns really, really well with the 50% fib retracement. And then here's the daily chart. The lows here were 187.50, but notice where the ledge is on the volume over price profile. It's at 190. So I think, well, definitely for sure, you break 187.50, then all hell should break loose. Given where it's at now, if you got a move down to 187.50, could be one last bounce before it fails. So at 190, for me, it would not be an all-in short kind of moment. I think we'll have a bounce before then, but 187.50 is going to be a very important level on the chart. Let's go through the sectors, because I think there's been some fairly dramatic changes over the last week that I want to point out. Here's materials. For the most part, materials have been doing well. They've been consolidating, and we've had breakouts in the past. This was a fake one. Came back to the bottom of the chart. Now we had another breakout, and earlier in the front part of this week looked like it was going to take a leg higher. You know, this has got your Freeport-McMoRans, all your lithium, your specialty chemicals, your fertilizer, all that kind of stuff is in XLB. It is not a big part of the SPY weighting, but it has been doing better with some real pockets, has gold miners in there, that kind of thing. But now look what's happened. We had a move higher that failed, and now we're back inside the prior trading range. And you can see on this last occurrence, our technical target of finding the bottom of the box held true. So going forward, my base case for this is to find the bottom of the box down towards 77.50. What would change my mind is if this thing came down to the 40-week, bounced, and then broke out again. So you can mark 87.50 on your chart as a breakout level, but also have 77.50 as a target on your downside. XLC, basically what you're looking at here is Facebook and Google. It's over half, well, it's 44% of the XLC. And here, I've taken the trouble to kind of show you that classic ABC move. Here's a leg down. Here's your kickback rally. Here's your measured move target. You can see that on last week, we broke below this ledge on the volume over price profile into a relative void with a measured move coming down to 58. And remember, we've got Google, Alphabet, and Facebook both reporting this week. So I would expect this to come down here. I would definitely expect a bounce here, but don't forget, with the earnings, there could be a potential for a kickback rally here. So there's always risk with earnings that there could be a positive reaction. Whether it sticks or not is a whole different deal. So, but that is the classic ABC type scenario that I would be expecting to play out. Here is energy. We all know energy's been on a tear. We had a bearish engulfing candle last week on energy where the high and the low completely engulfed the prior week's trading range. We had that, and I really think last week, and I think we said it Thursday and Friday, no place to hide. These names have been on a rocket ship, but when people decide to get out, they sell everything. We talked about gold miners. Gold was up on Thursday and Friday, or at least Thursday I know it was up, and miners got destroyed. They got destroyed on Friday as well, and they finally found the energy sector. So if you're long energy and you're still long, I would pull the ripcord on a move below 73. That will violate the midpoint of the weekly channel, and then my target would be back here at 63. So this is a $20 wide channel, and we have not been at the bottom of the channel since the beginning of the year. So it wouldn't take a lot of imagination to say we went to the top of the channel, then we came down to the bottom, and that would be a place where I'd be looking to buy if we made it down to the bottom of the channel. Notice the PPO is about to put in a high-level bear cross, and we've already dropped down from overbought down into the range. And once you do that, it usually doesn't reverse. It usually comes down here like it did before, come down to this 50% level, and then bounce back up. Quickly on XLF weekly, we've been in a $5 trading range for the better part of 9 months, even going back a year. Now we're at the low side of the box, below the 40-week moving average. I would have an alarm at 36. You break below 36, you've got a $5 wide target, and I would expect a move down towards 31. There is a ledge here at 33 or so. You can see it here, but you break below that, would give you the full move down towards 31. So on a break below 36, my first target would be 33, and then my second target would be down towards 31, 30 and a half. Very much the same scenario on industrials. $6 wide consolidation here between 99 and 105. We're sitting right on that level right here, actually 98. So maybe that's a $7 wide range. You break that going forward. Notice the big void in the chart here. I think you can go from 98, 97 and a half down here to 90, where you've got a large volume over price bar, and that aligns really, really well with the measured move expectation. If we adjust that to $7, because I didn't have that right, from 105 down to 98, $7 from 98 brings you down towards 90, 91. That aligns with this support area. I like that trade. You can see here that RSI is now been below 50 for a while, and momentum is just at the point of rolling down into its bearish regime. Shouldn't be any surprise that XLK technology has been weak. We've got an A move, a B move, and a C move, measured move that points down to 126. We are right at the February lows. You break below 141, I think you find this 126 on the charts. And as I'm going through this and pointing towards the targets, keep in mind all those oversold readings that we talked about early in this video at the beginning of the presentation. Tomorrow, you diligently go through and you mark this 141, and then tomorrow morning at 10 o'clock, it fires. That's not necessarily a signal to get short. Remember, these are week ending closing prices. So in the interim, you get an oversold condition on the daily chart. You get a kickback rally, come back towards 148 or 150. That's when you want to hit it. Once go down to the daily charts, wait for that kickback rally, then hit it once you think that kickback rally has been exhausted, and then that will set up for a much higher probability entry than shorting it here, because we're due for a bounce after this bout of selling has concluded. Staples has been a big place to hide. I've gone down on the daily chart on Staples. See the steep rally here? We're about to lose the 80 MA and lose this uptrend channel. I think we could come back, definitely back down into 77, where there was a peak support level, or even down towards the 50 at 76. So if you've piled into Staples, be pretty careful here, I would imagine. One of the things that we've also noticed is the sharp run in utilities as people went to safety along with the Staples utilities. Notice the yield on the utility sector is about 2.7%. And remember that the yield we showed you at the beginning of the presentation, that the 10-year is at 3% right now. And a lot of people have been amazed that people have piled into utilities, because utilities don't tend to do well in a rising rate environment. They tend to do well in a falling rate environment, because you get 3% yield, 2.7% yield in a relatively safe equity. But now you have no equity risk buying a treasury getting 3%. Why would you buy a utility making 2.7% when the thing can go down and wipe out all your yield gains in like a week? So I would expect this to roll down. I expect this to come back into this support area down here towards 71. So be pretty careful if you've been piling into utilities. I think they're coming back. The reason I show this healthcare is that it price came back into the range, lost the 50-day. Now, just from a technical standpoint, we're below the 50. We're back in the range. My default target is back towards 124 at the bottom of the range. And you can see here, baby fake breakout, bottom of the range, big bull trap, bottom of the range. Is this a bull trap? Kind of looks like it. Here, do we find the bottom of the range? And what I would point out is you've got a great trade location right here to watch in the days and weeks ahead. You get a little kickback rally above 135, and then you fall back below it. I think that would be a great trade, because I think you're going to, at a minimum, come back and tag the 200. And lastly, let's wrap up. XLY. Remember, Amazon is 25% of discretionary. A move, B move, C move. I think you're going to find 150 on this. Notice how volume over price support falls away. I think the door is open. I think Amazon reports this week. You have to double check that. But you get a break below 166-ish. You're going to get a move down to 150, I believe, and potentially even back in here to 130, depending on how it goes in the market. So I don't know if I should apologize for the long video. I hope you got a lot out of it. A lot of stuff going on. Review that first part of the video for sure with, the oversold conditions. Take a look at the positions that you have, and by all means, tomorrow is going to be a very important day to write down your game plan ahead of time. Maybe a couple of scenarios. If you're short, where are you going to be looking to cover? That kind of thing. Decide if you're going to try and play a bounce or just go to cash, wait for the bounce, and then redeploy shorts. A lot of different ways that you can approach it, but the most important thing is, they call it a panic flush for a reason. You want to make sure that you're not part of the people that are panicking. And the only way to avoid that is to have a written game plan, because if it's just in your head, you're not going to remember. When everything is going red, you are not going to remember that game plan. So write it down. Write down a few bullet points on what you want to do and when you want to do it. And then when that panic hits, you will be calm, cool, and collected, and you can face that market situation with fortitude and courage, and be able to step in and do what you want to do at the right time. If you're new to the channel, thank you so much for spending an hour with me. I really appreciate it. Hope you got something useful out of the video. Hit the subscribe button, the alarm bell. Jump over in the show notes. You'll find a place to register for all my content with a simple drop-in of your email. That way, morning, noon, or night, you'll get the content and be on the same page with the rest of the team. So let's wrap it up there. Enjoy the rest of your weekend, and I will see you bright and early tomorrow morning with Before the Bell. If there are any big, actionable, or dramatic moves in the futures market overnight. So let's wrap it up there. This has been Chris Buss with Traders Profit Compass. Talk to you next time.